Welcome to our webinar. My name is Ben Russell. Today, along with David Mitchell and Jenny Taylor, our job is to help you to understand a potential game plan for 2023, because there's some pretty interesting things happening in this market. So if you're brand new to TRADEway, we're really happy to be able to make acquaintances with brand new friends that are maybe going to hear a little bit different philosophy about how to do this thing called investing and trading. And at TRADEway, what we do is we think like traders. So I'm going to introduce you a little bit today. I want to make sure, though, that you understand that this is meant to be an interactive webinar. We're going to give you an awful lot of information today, but it's not just one way. So myself, Jenny Taylor, David, some other friends in the background, we're here to help you. So if you've got some questions, you can go down to the Q&A box and you can type a private question in the Q&A box. If you've got a general comment, you can just go over to the chat box. And in the chat box, you can say everyone, and then we can actually have a conversation with everyone. And I can already see some of our friends are doing it. I've got friends saying hello from Sarasota, Florida, Indiana. A question is already in about how long is this going to last? This is going to be about an hour and a half, Donna. So we got an awful lot of information to share with you today. A typical webinar for us is about an hour, but with all the extra content that we have about a game plan for 2023, you can expect this one to go for about an hour and a half. Great question. Any other questions before we get started? I'm appreciating, look at all of those amazing places all over the country where we have people joining us today. Well, so who is going to be on with us? Well, Pastor David Mitchell is our main speaker today. If you haven't had a chance to meet David, well, let me just give you a quick introduction. David's a businessman. Not just a businessman, he's also a pastor. He's been a pastor for over 30 years, an entrepreneur, has 4 different companies that he is a part of helping to run and to get started and to have a lot of that entrepreneurial know-how behind. And he's also the man who God gave the wisdom for how to be able to create the program that we'll be talking about today a lot in our webinar, and it's called AMPT, A-M-P-T, AMPT. Well, so Pastor David, I'm looking forward to being able to spend some time with you today as we start talking about this amazing thing called AMPT. Jenny Taylor, I'm looking forward to the help that you're going to bring. You know, you're going to be a part of this presentation too. And I'm looking forward to what it is that we have to share with our friends today. So let's get started, unless there's some questions. Jenny, is there anything out there that we need to cover before we get started?
There's nothing in the Q&A, and Cassandra and I will be in the background answering some of the questions as well. Just so you guys know, if you have questions, you can type them in. At times we might answer them live, but if Cassandra or I can answer them behind the scenes, we'll do that as well.
Very good. All right. Well, Jenny, I appreciate that very much. You're such an amazing help for this program. And some of our friends are going to get an opportunity to meet directly with you, myself, perhaps one of our other IARs. So I just want to make sure that they get an opportunity to kind of hear your voice, see you as well. So this is going to be a lot of fun. All right. So AMPT, A-M-P-T. Now, that is an acronym. Assisted Managed Portfolios by TRADEway kind of says a lot about what we do. We're assisting you in managing your portfolios. And what's unique is that it's probably the only biblically based long-term investment program of its type. And it's designed for safety. And you're going to hear through this presentation as to why. And it's backed by the authority of Scripture. Okay. So as we are continuing here, I think that this is where I want Pastor David, if you wouldn't mind, I'd love to ask you this question. Right. So let's say hello to our friends. I know that you like to, this is your first time on camera with our friends. Can you say hello? And I'd like for you to be able to answer this question, because this is your question. This is why you created AMPT, right?
Hey, Ben, can you hear me okay? Because it's given me a message that it will not let me start my video.
Interesting.
Camera,
can you please promote David to be a co-host?
Oh, that would be nice.
Technical difficulties, friends.
Yes, I did. Sorry about that.
So there you go. So Pastor, it's interesting because you, myself, Jenny, we would go to these seminars, and we've done a lot of live seminars together. It's been fun. And I know that we've had this question. We have people come up to us on the breaks and they hand us these statements. What should I do now that my financial advisor has lost half my money?
Yeah, well, that is the question we got more than anything during the first years of our company when we were just basically an educational company. That's really our main interest as we started out for many years, more than a decade. And so we knew how to answer people's questions, but we couldn't because we weren't FINRA registered at that time. So we are now, but we were not back then. And they'd ask me these questions. It was kind of gut wrenching because I would look at people's statements. And, I always remember the example of a person that had his financial advisor had bought a stock for about $222 per share when he bought it. And it was still on the statement. In other words, he never sold it. And it was worth like $22 now. So he left it on there all the way till the stock crashed and never sold it. And I thought, my, so that gave us in the bottom of our hearts a real great reason in the future from that point, to become FINRA registered so that we could deal with those. And that's what AMPed is all about. AMPed, we started AMPed because we wanted to help people pull their money away from people that would leave their money in the market all the way to the bottom of a crash, which to us is ridiculous. Our family's never done that in 4 generations of investing. And so I thank the Lord that he gave us the ability to get this started quite a few years ago and be able to protect people's money in that way. So, that's our forte. The number one thing is to protect your money. And, who was it? Was it Benjamin Franklin that said, I'm not so worried about the return I get on my money. I just want to make sure I keep my money or something like that. He was more interested in not losing the money than getting a high return. Well, we want to be able to do both. We want to help you preserve that money, especially in these market crashes like the one we're in right now, but also be able to get a nice return. And that's our goal for you guys. And I think we're doing a pretty good job. We'll talk about that a little bit more in a minute.
All right. So as we go forward, let's talk a little bit more about that why, because Pastor, unfortunately, those buy and holders lost an awful lot of money in COVID. $1 trillion from pension funds. We're talking people's retirement, David. $1 trillion gone. And it wasn't just the retirement funds. It was the world's wealthiest. They lost $1 trillion as well. So that was COVID. What about current day? We're in a little bit of a nasty market. So our main purpose for today, we want to help you to understand you don't have to be a buy and holder. So if you become a part of our AMP program, if you want to engage with us, we want to help you understand why we think that's a bad idea. We've got education about it. We want to talk about how investing can be done differently and what David, that's quoting you, it's the right way, which would be the what way? Oh, the biblical way, right? How do we properly diversify? How do we get safety and control? Because part of the reason why people buy and hold is they can't do differently. What if we gave you greater control and had that capability of being involved in positions that maybe even make money on the way down? That sounds a little crazy. You mean you don't have to just be in stocks? Maybe we can be in instruments that actually have the capability of maybe making money in a bear market. When's the last time your financial advisor told you about that? And then the last thing is that we're here to help you. People like myself, Jenny, and David, that's what we're here for, is to help you along the way. All of the clients that are part of our program have access to people like us to help answer your questions and to be able to help you strategize through these pretty difficult market times. All right, so David, I asked a couple of leading questions based on some friends that had asked us some questions, and part of today's webinar is about what do you see for 2023? Because we just talked about some pretty negative things for 2022, and this webinar is designed for us to hear from you so that we can begin to understand a little bit more about what you as our founder and a guy that's been investing through a few of these bear markets, right? You've got some perspectives to share with us about what we might be looking at for 2023. So here's my first question, David. Compared to past bear markets, how's this one behaving? And based on your experience?
Well, Ben, that's a great question. I think a lot of people are thinking about that. Is there anything we can learn from, say, the 2000 crash, the tech bubble crash, or the 2008 Great Recession, similar to what's going on now? Well, there are similarities, but there's some as well. If you look at the 2000 tech bubble crash, which was really a big tanking of the market, and a lot of people bought and held got in big trouble because they were told to just, stay the course, stay in the market. They always come back. The problem is the NASDAQ didn't come back years at. If you were in your 60s or 70s, you were in trouble because it didn't come back in your lifetime, basically. So yeah, maybe they're right when they say they always come back, but they don't tell you how long it takes. So that was a particular problem with that one. The thing that's similar is that one that was caused by a bubble that burst. The tech companies back then are not like they are now. They were just starting out. Think of crypto right now. Think about what crypto is like right now. And it was a little bit similar, except that the tech companies had real products. Okay, I'm being a little bit facetious there, but the point is a lot of those tech companies were not even profitable yet, and they were selling for $250 a share, which back then was a lot of money. And then all of a sudden, when the whole world had just a bit of recession scare, and people realized, you know what, these companies aren't going to be making enough money in the next 2 or 3 years to merit this price. It just tanked. Well, there's some similarity to that right now. For example, we just had a big event in the crypto world, didn't we? If you're familiar with the FTX fiasco, went bankrupt, and now you've got all these other companies dominoing, and other companies going bankrupt in the crypto world. And the stock market is different now because tech companies now are way stronger financially than they were in 2000. So the stock market is not as similar as the 2000 crash, but that crypto market, which is kind of a market in and of itself, it's very similar. And when you watch what's happening there, that's kind of what happened with the tech stocks in 2000. So there are things to be learned by watching it, such as you need to understand the risk when you're dealing with new technologies. Crypto is extremely risky. Should never put very large percentage of your money at all. And then they lie about it. It's like having silver or gold. There's no comparison whatsoever. It has hurt the gold and silver market because a lot of newbies to the market have bought into that, and they think they can put their money in crypto and it's like long-term protection. It's the opposite, actually. So very small percentage if you're going to put any in crypto, because it's so risky right now. It's a new technology, a new market. Well, that is a little similar to 2000, but the stock market as a whole right now, I think that, the stock market and the tech companies, they're stronger than they were. So that's the good news. Now, if we want to compare it to 2000 crash, if you want to talk about systemic risk, which we may talk about that more, or we may not today, I don't know, but systemic risk is where you could even be one company that has such a huge, it's such a large company, and it has a failure of some kind that it begins to affect the entire industry group it's in, or it could affect the entire economy of the country that it's in, or even the world. And that's called a systemic risk problem. And 2008 is what that was about. And if you remember, there were 2 days there where Warren Buffett thought he was going to lose everything he had because he thought the entire economy of the West was going to collapse in the 2008, the first few days of that. And so I don't think, if you look at crypto and you think, well, could that cause a systemic risk to the entire Western economy? I don't think so. For this reason, when you look at the total amount of money in the crypto market, the whole market in the whole world, it peaked at about 2.9 trillion in November of 2021. And then, of course, it tanked. And I've been telling people for years it would, and it did. And it tanked and lost way more than half its value. So as of December of 2022, just last month, it was only worth 798 billion in the whole world. That's all the money that was in the crypto world. Now, if you want to compare that to the U.S. stock market, right now it's about 49 or 50 trillion dollars. that's in the U.S. stock market and the derivatives market, like options and so forth, another $1 quadrillion. And so you can see how the amount of money in crypto is not large enough compared to that to tank the whole system. At least it doesn't appear to be. So I think it's hard to see how that could create a systemic problem. But I mean, we're watching it, of course, but it's more of a problem for people that bought into some of the lies that people tell about crypto, trying to make it appear as if it's as good as gold or silver for long-term protection, things like that. Like, they tried to say things like, well, the blockchain, it's impenetrable. Well, now, there are billions of dollars that were stolen, just gone from FTX. So there were an awful lot of false promotion lies. They're not registered by the SEC, so they can pretty much say anything they want. It doesn't mean it's true just because you read it in the news. All right. So, Ben, I think, you have those comparisons. Number one, I don't think that we're looking at a systemic problem. The only thing I worry a little bit about along those lines would be something happened to the junk bond market. The bonds that corporations sell, those could get in trouble if we had a liquidity problem, which we could get, and that could be a problem with them lowering the money supply. So I would be watching that more than crypto to create some kind of possible systemic problem. But so you can see there are similarities, but differences. Our companies are stronger and in better shape, so are the banks, than back in 2000 and 2008. But we could have a debt problem if liquidity becomes an issue and so forth. So we're watching that. The main thing, though, Ben and Jenny and our crowd out there, guys, by the way, thanks for giving us some of your personal time on Saturday. Appreciate that. But the main thing we're looking at, it's definitely a bear market crash. And it may end up being a pretty typical one, and that in itself needs to be managed. So we'll be talking about that here today.
Okay. Well, so David, we've got a couple slides here that you asked me to put up. So this is the S&P 500, and this is our current bear market.
Yes. I just thought it might be kind of interesting to visually see how this compares. This is our current one. And of course, most of that was the bull market on the left side moving up. That's the previous bull market that lasted so long. And you can see on the far right side is where this bear market started. And so at the low, which is the most recent bottom on the far right of that chart, it was down 27.54% in this particular bear market. Now let's go to the next slide. We compare that to the 2000 and we got some more info on this one, didn't we? Did I miss something there?
No, it's all right. These are the market comparisons.
Okay. All right. So yeah, if you look at the difference in 2000, by the time that got to its ultimate bottom and began to move back up, it had lost 50.5%. It took 31 months. Now we taught years ago in our educational material that the average bear lasted 6 to 9 months. And that was true, I guess, for the first decade we taught. But now these bear markets last longer, and it's because the Fed is interfering with the free market so much that because of Keynesian economics, which Keynes was a brilliant British economist, but I think his brother was the devil. But anyway, I don't like Keynesian economics. But what it does, it gives governments control through the Fed, and they can print money or they can destroy the money. And that's what they're doing now, is they're lowering the amount of money out there in our economy. And so that causes these bear markets to last longer. So we got to pay more attention to them than we used to have to. The 2008 lasted 17 months, and it was even a bigger loss because of the systemic problem of the big banks and big Wall Street companies going broke, and the government having to, pump money in a couple of them to save them, or else we would have lost the whole economy of the West in that one. But that lost 57.69%. Now, what if you had a financial advisor that said, well, just stay the course, just leave it in, it'll always come back, and you lose almost 60% of your total money in the world. And by the way, that's when I met my good friend John Quinn, who was one of our great speakers for so many years, and now he works full-time at Exos Aerospace. But he found TRADEway because his financial advisor in 2008 lost more than 50% of his total money. And he heard me on the radio and said, you know what, I'm going to try that out because I want to learn how to do this myself. And that's how I met John Quinn. But there it is. It actually happened that way. And in the 2022, the one we're in now, I facetiously called it the Biden bear. He didn't totally create it. There were problems there before he became president. So he hasn't helped the problem, but he didn't cause the problem probably. But anyway, so far it's already lasted a whole year. Doesn't seem like it, does it, Ben? But I mean, well, maybe it does, since you guys are the ones that had to keep trying to manage this thing in and out, in and out. But it's been 12 months already. So that's already longer than what we used to teach they lasted. But as I said, they last longer now. And we've lost down to 27%. So look how much farther it could go, ladies and gentlemen. And we think it's not over yet.
Wow. Okay. So let's make sure that I want to make sure I heard you correctly. So you're like, previous bear markets, because of what's happening in the Fed and the keys, they seem to last longer and they go down further.
Yeah, they do now. They seem to last more months into the years now rather than months. And they take away more of your wealth if you leave it in the market. So you don't want to be in the market all the way to the bottom of one of these things.
Okay. And I think I heard you say that you don't think we're done going down yet?
No, I don't. I think we might be halfway or maybe a little more than halfway down, but I think we're going to see a recession in 2023. And we haven't even officially, the government's not admitting we're in a recession yet. So that hasn't even happened yet, but it is going to happen. And now the market's got to go down farther as that happens, because the reason is they're lowering the money supply. And when you do that historically, I think we got some charts on that later today, but historically, when you lower the money supply, it always creates a bear market crash. And as long as they continue to raise the interest rates on purpose artificially, that will lower the money supply, and you're going to see more down moves because of that.
Wow. Okay. Well, that's great perspective from a man who's been through these. So thank you so much. Here's the next chart. You wanted us to look at the S&P on weekly. What is this telling us? All right, so the S&P.
My grandbabies forgot that I'm having a webinar, so is what that cute noise was.
Well, you know what? That's why we work from home and why we work remote, because we're real
absolutely.
We have real families, right?
That's why we have TRADEway, so all you guys can do the same thing. I mean, that's create a family business out of it. So this just shows the little section that we're in right now. And it's lasted 12 months. If you look at the far left, you can see the COVID crash, which looks tiny compared to this one, but that was a pretty big crash, really. And it's the first crash I've ever seen that had a V bottom. I've never seen that in my lifetime. They always have a double or usually a triple bottom. And I think that was unusual, and it was just because of what caused it and so forth. But I think this bear will probably continue down, probably even steeper than it is. That's not a real steep move down. I think it'll get steeper, and it'll probably end with a triple bottom someday.
Okay, so here's the next chart. This is the current bear. Now this is put on a daily chart, right? So you were showing us weekly just a second ago. Now this is daily. What are we looking at here?
Yeah, I just blew it up there so you can see. If we want to talk a little bit, Ben, eventually in our presentation today about, well, what do we do? Because I think I can speak. We have a lot of our AMPed clients that are also TRADEway clients. So that means they've been studying how to do short-term trading on their own. And through AMPed, we're interested in your long-term retirement, but we have a little bit of trading in it, built into it through UP, which you'll talk about in a little bit. But the point is, most of you guys are kind of interested in both. Even if you haven't learned to trade yet, which you certainly can if you go out to TRADEway.com and you check out the great educational programs out there, you can learn how to trade. And by that, I don't mean day trading, but like you usually let the stock tell you how long to stay in. Maybe a couple of weeks in an up play would be a good average. And you can learn how to do the short-term trading. And I think at least 10 to 20% of your total money in the world, eventually you should get good at trading. And the cool thing, Ben's going to tell you a little bit about one of our AMPed programs that allows us to do some of that for you also. But by looking at this, you can kind of start to talk about, well, what can we do with the long-term funds in a bear market like this. And what could we do if we were trading? And so what you can see is it's making little upside down flags. So you guys that have been through step 1 and 2 know what flag patterns are, and you're used to seeing them sloped up, in an uptrend. Just pretend it's upside down. It's the same thing, it's just upside down. So that gives you some input along with these moving averages that you can see, those lines as well. It gives you some input on when you might want to go to cash, number one. And then secondly, would there be a time you might want to go into what we call an inverse position that can actually make money on the way down? Now, Ben, you might take your pointer and show them where we actually did that recently on this chart. There might be more than one place, but show us a place where we actually had money in inverse.
So right here, as the markets broke down through the 20, we had money in the inverse. Right here, as the markets broke through this area right here, we were in partially here in an inverse. We got more money in the inverse here, and then we took profits right there.
Yeah. And that may not look like a lot, but that's a lot. That was very wonderful to be able to do that. Ben will talk more about how AMP can help you with that. But this chart, once you learn how to read charts, which you learned that in step 1 and step 2, and you can do it online. Eventually, Ben, we hope to have live meetings again. After COVID, we had to go online, but we're planning some.
That's awesome.
Yeah, you learn how to read these charts where your eye gets used to what that looks like and what it's telling you. But that one is pretty, I mean, Ben, wouldn't you agree that one is pretty enough? We should probably add that to our step 1 charts to teach people how to do charting.
Look,
perfect.
Pivot,
yeah.
pivot,
yeah,
pivot, pivot, pivot. Wow, it's like maybe these lines mean something.
Yeah, exactly. And when you're talking about breaking out, he's talking about it would go up and hit that line, what that we call the resistance line, and bounce down, and then even go through those moving averages lines going down. So they were breaking out, moving down. That's when you could buy puts if you know how to trade the put options, because they have potential to make money on the way down. Or with the long-term money, we help you get into inverse positions that can make money on the way down.
What? That sounds crazy. So you mean it as a part of investing, we can actually help people get into something that makes money when the market's crashing?
Yeah, and that is not common, right, Ben? I mean,
No.
when we started working with AMP, it wasn't anywhere. And it's not hardly anywhere now either, where you can, what they want you to do is to hold your positions, just hold them through this. In other words, they don't want to see you get in and out of the market. And there's still a lot, even some of the young guys, I spoke to one recently, Ben, on the phone, and asked him what he was doing with his portfolio. And he said, well, I've built mine around buying and holding through these events.
Wow.
As long as I can make sure, that certain things happen, we buy and hold. Well, I understand that viewpoint's taught in the MBA programs, but in the real world, like the world my grandfather and father and myself and my kids now trade in, and all of you guys, my TRADEway staff, and all of you out there, you don't buy into that anymore. It's just not, it's not how this market works. So you don't want to be in that thing all the way down. So, that's the main thing. They're going to want you to do it, and we don't think you should do it. Well, I think that's one of the greatest advantages of AMP right there, Ben.
I would agree with you 100% that we have a very different philosophy, and we've helped an awful lot of people. Okay, David, let's move on to our next question. And this one's a little bit longer, right? So you've given me some information. Now, this is a little bit of an eye chart, but I asked you, what are the things that we're watching for? What are some of the things based on your experience that you think are probably going to be the primary issues for 2023? This webinar is all about getting a game plan for 2023. So, right. These are the things we're going to watch. So let's talk through these. Well,
one of the things, one of the hardest things to learn as a new student is how does the news affect the stock play you're in? And so we call that market tone. And that's why we help you with that for the first 3 to 5 years of your trading life, because it takes longer than that probably to actually get good at that. You have to actually trade with real money through several bull and bear markets to be real good at market tone. In other words, how the news affects everything. So, usually what happens if you're just looking at a particular stock, I need to send a text here. Hold on one second. Usually what happens, is you'll only have one or two, three at the most news items that have anything to do with the stock play you're in, and everything else is just noise. And every part of that, everything else can even be articles where on purpose they're trying to get you to do what they want you to do, but it's not the right thing to do. So that's what makes the news difficult. So normally, though, there are only one or two main things you need to be listening to, maybe three at the most. And because you get market alerts with most of our products and services, that's where we help you with that. And so now we're going to be looking at more than just one or two or three things, because if we're going to develop a game plan, we not only have to look at what the two or three things in the news today actually are, we got to look at things that might be in the news tomorrow, right? Over the next few days and weeks and months. So these are things that we're going to be looking for. And I don't mean all of these are major in the news today, but throughout the next 6 months, any one of these could make its way into the top two or three. You see my point? That's kind of what we're looking at. First one, of course, is inflation. And even though that's not the main thing we're watching to figure out which way the market may be going to go, it relates to the main thing. And I'll discuss that as we get to it there. But let's just talk about inflation first. Right now, inflation is higher than it's been in, 40 years, maybe longer.
Well, let's talk about
Jimmy Carter day.
That's actually the next slide. So this is inflation. Let's talk a little bit about it and why does it matter? Yeah.
So if you follow that, you look back to the Carter years in the 1975 on the far left there, inflation got really high. It hasn't quite gotten to that number yet. Well, it depends on which inflation you're looking at, whether you're looking at the one that includes gasoline and food, groceries or not. But this one shows that if on the far right, which is where we are now, it didn't quite get as high as that, but it got over 7.3, I think. I don't remember, Ben, unless you do the exact top it got, but somewhere around 7.3 inflation. Now you think about, no, it might have been more like 7.9, actually. I think it was. But the point is, you're looking at almost, when you get to 8% inflation, it's almost like if you put your money in the bank, it's like you're going to lose 10% of that money every year. And you think you're saving it, but actually you're losing 10%. So you've got to make 11% on return on your investments, to make a percentage point for your family. That's awful. So my son, Ben Mitchell, has put together a whole division of our company about precious metals. And in that, he teaches the history of money all the way back from the Bible times till today. And he points out how every government, without exception, every government has learned in history that inflation is an invisible tax that the average person doesn't know anything about. And it's the way the government can tax the people. So they inflate the money where the money is worth less and less every year. And even our government thinks, this is Keynesian economics, Ben, that it's healthy to have 2% inflation, and that you don't want to have zero. Now, the Bible would say you want to have zero, because the Bible would indicate what you want is gold and silver to be the base, and it doesn't inflate. It just stays the same. And if you locked your money in like it was before Nixon here in our country, that was a good thing, but they unlinked it. And so now it can go anywhere. So 2%, do you really want to lose 2% every year? I don't think so, but that's what the government thinks. Well, we were right there around 7.9 or so percent, and now it dipped down just a little bit. So here's what the news people did. They just sort of took that and ran with it, and they tried to make that look like good news. Well, inflation has topped, right, Ben? That's
right.
Every news article. Inflation has topped, and I don't know if you noticed a while ago when Ben showed you where we did the inverse plays, but that last one we got in the day before they printed one of these articles, and it shot the market up. So we got in something that should make money when it goes down. It shot it up for 2 days, but we stayed in it because we knew that that was fake news. Just because it's topped, it's still at 7.1, and that's horrible. And the Fed's not going to let it stay there. They want to push it all the way down to 2%. Now, if people have any understanding of how much you have to take out of the money supply and how many even years that could take, even with taking the money from the money supply, which makes it harder to buy homes, harder to start businesses, even harder to keep your job, right? How many years of that it would take to go from 7.1 to 2? We're going to talk about that in a minute, but it's a lot. So we stayed in there, and sure enough, after 2 days, the fake news was over and it tanked, and that made quite a bit of money on the inverse side. So this is where we are on inflation. It is like it's the number one root of the problems. The thing we're watching, of course, is what's the Fed going to do with it?
Right.
So I guess the second thing we would talk about and looking at in the news is the money supply. And all this is related, because when you talk about the Fed reducing the money supply, well, first of all, there are two designations for money supply. You got M1 and M2, and I put that on the screen for you. You learn that in economics and then you forget it, right, Ben? I always have to go back and review the difference from time to time. But basically, the M2 includes savings and some other types of deposits that M1 doesn't include. So M2 is probably a good measure. M1 is just cash, and things in treasury notes, coins, paper money, things like that. But anyway, they're both represent the money supply. Now, what happens when the Fed gets afraid of inflation? They begin to try to artificially raise the interest rates on the U.S. Treasury notes and all those things, which causes the intent is to cause all the interest rates to move up. It makes it harder to buy a house because you're paying, 9% interest instead of 1.2% interest like it was even a year ago or whatever. So you've already seen one of the first things this affected was the housing market. It tanked first. And it is like the canary in the mine. Okay. So that takes a little bit longer for that effect to affect the companies. But listen, the large companies like Amazon, like Apple, like Elon Musk's company, Tesla, they have laid off tens of thousands of people in the last 4 weeks. Even up to yesterday, they're still doing it. So it is beginning to affect the companies. And so the money supply, see, when they raise interest rates, it makes the money supply go down. If you take economics, you understand that. If you don't, it makes no sense. So just trust me, because debt actually creates new money. So when you make debt harder to get by raising interest rate, it creates less new money. And it gets to the point where the money supply as a whole begins to move down. And when that happens, there's never been a time in my life when the stock market didn't crash. Okay, so money supply is something big we're looking at, and it is related to, what the Fed does by raising interest rates makes the money supply go down. All right, so you can do the next one there. This is M1, a chart of the money supply. And one of the things that's frightening about this, I think Ben had this in this presentation last time we did it, one very similar, where you look at all the way back from 1960 until 2020 and the money supply where the government's printing money and creating new money, it didn't raise that much compared to what it did right just since 2020. Look at this. This is frightening. This is printed new money right here. So, and we kept saying, didn't we, Ben, 3 years ago, we kept saying inflation's going to hit eventually. Well, it surprised us how long it took, I think. It did me. In the old days, it would have happened sooner. But one of the reasons it didn't, the banks weren't releasing all that money. They weren't loaning it out. So it didn't get into the economy.
Well, and I think the reason, Pastor, why we want to talk about this is that these are some not so intuitive things that are going to have impact in 2023. So as we start talking about things like the money supply, there is a ripple effect that happens throughout all of the things that affect us, not only as individuals, but primarily as investors. And we just want to make sure that you guys are exposed to some of these headwinds that we don't think we're done. We think 2023 could be a really difficult year.
Well, yeah, if you look at the top far right of that and the top where it just turned and started down, do you see that that's just a tiny little move down compared to that huge move up? And they're going to have to move that down almost to where it was in order to get to 2%. And they're not letting anyone know how long that's going to take, because that'd scare everybody. You'd have an instant recession. So they just lie about it. But we know the truth. You can go 2 slides forward. That one. So that just shows a little bit close, blown in a little bit closer. It's done in millions of dollars rather than billions, and you see more detail. But still, it's the same. That little move down on the far right is all that they've accomplished so far by raising the rates as much as they have. So they got a long way to go of raising rates and stopping printing money, and to get that down to 2%. So that's. I think let's go to the next one. I think it talks a little bit about the velocity of money, which is kind of interesting. And that's not a term everybody remembers very much, even if you took economics. But basically, it's like the number of times that a single, picture it this way, like a dollar bill that's in your billfold, and you go and you spend it. Well, the shop owner eventually is going to spend it to buy more goods for his store. So he spends it. Then the wholesale company that sold him the products is going to spend it and give it to the farmer, right? So it's used, that same dollar was used 4 times.
Wow.
Now, the velocity of money is how often is a dollar used, and how over what period of time. And so what's interesting to look there at 2020, can you see the velocity of money tanking right there? So that's kind of creepy to me. That, you know what that tells me? It tells me a lot more than what I'm reading in the news, because in their news, I'm just saying retail sales are still hot, and the American consumer will hold this market up, and we're probably not even going to have a hard landing. But that tells me the American consumer and the big boys are not spending the dollars as often as they were just a couple of years ago. It's just tanked almost down to nothing. So it's not down to nothing, but I mean, comparatively speaking, that speaks a lot. The velocity of money is falling. And I think the next one is the same thing with the M2 money supply. So it shows the same thing. And, that's pretty interesting. Now, let's move to the next one, Ben, where it talks about the Treasury yields. And this is how the Fed makes those things happen, like that money supply start to move down, is by raising the rates. And here's a chart that shows the blue line pictures inflation, and the red line pictures them raising the rates. And you can see how there's a little bit of lag between when they raise the rate and when inflation starts to move down. And so that's kind of interesting. Now, if you go out to the present, which is on the far right, you can see that the core inflation has moved down, but they started raising the rates, a year ago. You can see where that little red line started moving up, right? A little more back to 2020, actually, that little red line started moving up. So it took a year and a half before inflation even started moving down. So you can see that you got to put the pedal to the metal on raising the rates in order to get inflation to move just a little bit. And that's the point of that slide. All right. So if you look at the next one, you can see how they've been raising the rates. If you go all the way back, in the past to 2010 and back in there, they there was a time period right before 2010 when they raised rates for just a few months, thinking they needed to pull down inflation. And then you get closer to middle of 2019, you can see, right, look at the end of 2019. Can you see how that line started moving up right there, the last quarter? They were intending to try to lower inflation right there. And then guess what happened? COVID hit. And they were afraid the entire economy would be destroyed. So they stopped raising rates and started printing money again. And then you can see there that the Treasury rate went all the way back down, even lower than it ever had been. And so they're trying to drive the economy that only God can drive. And that's what's foolish about Keynesian economics. It's man trying to be God, and they never succeed at that. So now where are we? We're at the far right end of that thing, and they finally got the rates moving up and inflation moving down slightly. So that's where we are now. This is interesting. Just to give you an idea of how long this could take, in June of 1975, President Carter was the president, and I remember it so vividly because I was, I don't know, high school, a little bit beyond high school age, trying to buy gasoline at the pump, and the price of gas was going up and up and up because the dollar was worth less and less and less. And so inflation got to be 11.7%. So you lost that much of your savings every year by putting it in the bank when Carter was president. Now, by June of 1983, President Reagan had fixed the problem, and inflation was down to 2.9, which is kind of where they think. See, they're talking about taking it to 2. I guarantee you, Ben, one thing we're going to have to watch is the market's going to go up sooner than we think, because they're not going to take it to 2. They're going to come out and say, you know what, we think 3 is the new 2. And then that'll cause the market, the new bull will start right then. So you guys can watch for that news, because that's when I think that's about when it'll start. But so think about this. The Fed had to raise interest rate from 7.99 to 13.92%, which is 6 percentage points, which is like 600 points. When they talk about raising it 50 points or 75 points, that's 600 points between 1977 to 1981. And then they had to raise them again 3 percentage more points from 82 to 83 just to get inflation to fall from 11.7 to 2. So look at the time period that you had to cover there. 6 years or more is what it took. So this is going to take some time to solve the problem that they have created by printing all that money. And the whole time that they're raising the rates by 50%, not percentage points, but 50 points or whatever, it's going to be almost impossible for the stock market to start a new bull. If they float the news that they're not going to take it to 2, they're going to take it to 2.7, I think you'll get a little uptrend at that point, but it still may not be the end of the bear. So those are things we're looking at. So obviously, when you're looking at the 10-year treasury yield, the velocity of money, all these things we've looked at, another thing, that we would be, oh, that's cool. That shows that little section of time there where during the Reagan years, where the S&P actually tanked because they had to raise the rates to get that 11% inflation. They had to kill it, right? Look how that tanked the market. But look what happened to the market just after 1982 when they fixed inflation. That was one of the greatest bull markets ever under Ronald Reagan. And it had to tank it to get there, though, a couple of times. And then it created this.
So hold on a second. I think you just said, David, that there's long-term cycles in the market, that there's some factors and things that those who know it can actually start to think differently about how they invest.
Well, sure. I mean, one thing is watch the money supply. All those little gray lines moving down are recessions. And if you notice, the money supply has to move down before that recession happens. And I'm not sure that's the best chart for that. I've got another one in there, I think, for that. But it is just interesting when you know some of these things. And we try to share that information with you guys. We don't want to just have information that you don't have. We want you to know what we're looking at and why. So this is a really good chart to show you the difference between when the money supply is lowered and when recessions happen. And the GDP is how well the economy is going. So it's pretty easy to predict recessions and bear markets by looking when the money supply starts to head down, which is that red line. If you notice right before all of the gray lines, the red line goes straight down. That's the money supply. And you also see GDP going down. So you can move all the way across there the whole way, and you can see that all the way across. And so that's why it's pretty predictable. Now, if you look at the far right, it shows where we are now. So you see the red line moving down, where the money supply is moving down. The GDP is much lower than it was. a few years back. And unfortunately, this doesn't go all the way up to the current, but it would look kind of like that on the far right side if you went all the way out to 2022. So those are the things that we look at. Now, what about this Russian war? That could be a problem, couldn't it? Increased oil prices because of the Russian war could be a problem. That just makes inflation flare back up. We don't really know that we've seen the top of inflation. They just say that because they want the market to go up. That may be a little retracement, right? I mean, inflation will hit up most assuredly if oil prices move back up. They're down to $75 a barrel. They were up closer to 90. What if they move up to 100? You don't think that'll affect the inflation? And then you could have systemic problems like crypto. So we're watching that. I've already discussed that. You're going to see regulation of the crypto market. And so those are 9 things that we're looking at. This chart that Ben's got up there right now is probably the best chart I've ever seen. I didn't find it until yesterday. I had charts like this already, and I found this. I went, wow, this one is really great because it's so clear. The black little fine black line moves down every time you see a recession, and that is the beginning of the recession. It just barely has to move down a little bit and the recession starts. And you can see that all the way across until the most recent one on this chart was 2005. But it's that way all the time, and that's what we see happening now.
Very interesting. All right, so let's see. Pastor, that was a great session where we figured out that there's a lot of complexity in the background that can kind of give us a feel for what we think the market's going to do in the not too distant future. So the buy and hold thing, does it really make sense to buy and hold when we know that metrics like this have such long-term impacts to the economy and help create these cycles?
Well, it makes no sense. And, they always tell you in the business schools and the government, everybody wants to tell you can't predict the market. Well, it's not exactly accurate to say it that way. It would be accurate to say you can't predict it all the time, right? We can't know the future all the time, but we just showed you 5 or 10 charts where when you see the money supply lowered on purpose by the Fed raising interest rates, that you get a recession, that's predictable. And to say that it's not would be to lie to people. So if you see that you have these big cycles, and the ones we're concerned about are the ones moving down, right? And you see that they're somewhat predictable in how you can look at different tools to help yourself know when you're there or close to there, then why wouldn't it make sense to, for example, go to cash when you see one of these just about to happen rather than staying in the stock market? And if you can, on the way down, go ahead and get some inverse positions and make money while it goes down. Why doesn't that make more sense? And that's what AMP's all about.
Well, and it's interesting too. I just pulled up the next question, but let me comment on what you just said. I just talked to a brand new AMPed client this week who wasn't understanding our philosophy. So I walked through what you just did. It's like, why don't more investment advisors do that? I went, that's a great question, but you do.
Yeah, that's the unknown question there.
Well, I think that there's a couple of different answers for it. One is they genuinely believe buy and hold works because it does, quote unquote, come back. The problem is they don't tell you how long. We've said that before. And I recognize there's one more thing. People do things that are beneficial for them. Right. You being invested in the market, if you go to a large institutional investor, I won't say the name, but we mentioned them earlier. They have these things called mutual funds, where guess who's making money when you're in the market? They are.
It doesn't matter if they're getting it right or not. They still make their money.
So you just got to look. Why do people do what they do? It's beneficial for them. Friends, what we're trying to do is expose a different way where you have some opportunities to do things very differently. Okay, David, next question. Look at this. When do you see the bear market potentially bottoming? All right, you just gave us a lot of things to be concerned about. What are you going to be looking for to maybe know when it might be ready to pivot?
Great question. Like we could put it this way. We've looked at a lot of things about why we think this bear is not over, right? But how do you tell when it is almost over? So that because one thing we've taught for 2 decades at TRADEway is that the best trading time in your life is what we call the first year of the next new bull market. Well, that's coming. If we're in a bear, then that's coming, isn't it? Now is a fantastic time for you to be going out and taking advantage of the educational services there at TRADEway.com and get really good at technical analysis and all those things, right? Get really good at looking at stocks, charting and things, support and resistance lines. How do you know when to place the trade? When's the good buy point? Now's the great time to be practicing and get good at it, because when the next new bull starts, that first year is the best time to be trading. So get ready for that. Now, how do we know when that's coming? Well, the first thing is first of all, you have to know that the bear market is going to last 6 to 9 months. So if you see a rally attempt before that, it's just that, it's an attempt. It's not going to be the end of it. And now we have to extend that because the 2000 bear lasted 31 months and the 2008 lasted 17 months. So they last more than a year now. Well, this one is a year old, but we've seen some things in those charts that we just showed you that make us think this one's not over yet. So it is significant that it has lasted for a year, but I don't believe it's over yet. But once we get to the place out there where it's gone on for a while, and if the Fed starts signaling anything about, well, maybe we don't have to go all the way to 2 on the inflation rate, then we want to start paying attention to attempted rallies. And so what happens is the market starts to move up on the major indices like the NASDAQ and the S&P 500. They'll start to bounce up and have higher closes than the day before after many months of decline. And so that's the first thing you look at. Now, what you look at after you see that is you want to see what we call a follow-through day within 4 to 7 business days after that rally begins. So what you're going to see, if you know how to chart, you're going to see a big clear candlestick moving up when that attempted rally starts. And within 4 to 7 days, you'd like to see another big clear candlestick up. And if you look down at the volume bars beneath those, both of them need to be much higher than average and higher than the day before. And that's something we look at to say, okay, that's a follow through. This might be more than just a rally. And so that's the first thing that you would watch for. Okay. Now, it can, if the follow through takes 10 days, as long as it's inside of 10 days, that's okay. But it's much stronger if it happens within 4 to 7 days. Now, what's interesting, if you went back to, you don't necessarily have to do it, but if you went back to the 2002, you would see that there was a huge clear candlestick and a follow through on March 13th, 2003, which was at the end of the 2000 tech bubble. There's a candlestick that went up 3.48% in one day. And then on the 17th, just 5 days later, there was a second one that went up 4.23, even bigger, the same day on higher volume. That was a great sign that bear market might be over. So at that point, we were starting to look at other things. Could this be the new bull? If you look at the 2008 one, within 8 days of the first bottom that it made, when it started moving up, it had a clear candlestick follow through of 6.6% in one day. So those are things we look at there. Now, that doesn't mean that when you see that, you're going to jump out and start buying a whole bunch of stocks. What it does mean is you're going to start looking for this right here. Now, mark this down. If you haven't written anything down, write this down. In the first year of the next new bull, you should see some new companies that you never saw before, completely new industry groups, perhaps, with new leading stocks, not the old ones. And if you're thinking if you buy and hold and you're still in Apple and you're still in Amazon and you're still in some of these types of companies, you may be sad about that. They may never be great growth companies again. So they're going to be new companies that you've never heard of. So watch for that. That is a great sign to watch for. 1 or 2 or 3 brand new companies you never heard of, maybe even in a different industry group that is leading the next new bull market. And then the fourth thing is usually the last leg down will make what we call a triple bottom before the market heads back up. So those are some of the things, and that's a big one, but those are some of the things we like to look at to try to tell if we're starting out a new bull market when this bear is over.
That's awesome. Well, thank you, David. We're going to ask a few more questions later on, but I think maybe our friends let's see how those skill sets that you just described and some of those things that we do as part of the AMP program. Why don't we look at how we did this year? All right. So
Absolutely.
It's been a pretty nasty year, but what happened is that our team actually gave input and guidance to what to do in this market all the way through what you see on the screen. And every place where there's a red arrow, our team was giving updates and alerts to what it is that we expected to see happen. So I just want to call out a couple of them. I'm not going to go through all of them for sake of time, but I think it's really important to recognize that the market moved down really strongly over the last year. What did our team have to do? And what did we say as it was doing it? And what did we tell our clients? Let's go look at a couple. All right. So here we go. Going to cover up the chart. Just going to point at where it is that we actually have different advice that we gave and what is it that we were seeing. So January 5th, big idea. There's a doji candle near resistance. Markets seem to be showing it's time for a rest. All right, here's the actual alert. This is written by this guy, Ben Russell. That's me, right? I'm one of the people that writes these. Is there anything happening news-wise that may accelerate this move back down? And in fact, there is. There's a Fed meeting coming. It looks like this market's ready for a reason to move down. And what happened next? Oh. Well, wait a minute. You can't predict the market. I don't know. I mean, it's not like you can get it right every time, but you can use that probability math. You can use the charts. You can use the news, and you can start to position yourself. It's interesting. There's opportunities there. Are you listening? There's opportunities here. David, you're on mute, by the way. You're on mute.
Cut out some of the grandbaby noise. All right. So, yeah, that's fantastic. And one of the things I like to tell new people who are thinking about AMP is that you can check our archives going back in history. And I won't say every major correction. Now, correction is not even a bear market crash. It's just a move down for maybe a couple of weeks. And those happen sometimes 4 times a year, which that's important to know. But every one of those, with maybe 1 or 2 exceptions going back for many, many years, we've been able to let you guys know anywhere from 1 to 14 days before these things happen that you might want to be thinking about going to cash. Now, that's pretty powerful. And there's a couple that we missed the very top and it went down for, a week or so and then pull back up. And we were able to say at the pull, when it pulled back up, hey, we think this is hitting a moving average, going to bounce farther down. Let's go to cash. So if you allow that little glitch, you can say all of them. We've been able to warn our people to go to cash.
Okay, well, let's go look at another one. So here's another one, Pastor. Look, sellers are gaining momentum. The tech sector is now in a correction territory. So what did Pete have to say? Well, based on yesterday's candle, this could be the start of a new downtrend. Does that sound like helpful advice?
It sure does.
Okay, well, let's see what happened. What happened next? Oh, very interesting. How did it happen? Because you got people that think like traders, not just buy and holders, that are looking at the market and looking at what's going on with the news and these technical patterns. All right, Jenny Taylor, who's on our webinar with us today, take a look at what she had to say. It's hard for me to anticipate the market is going to keep moving straight down. It doesn't just move straight down. It doesn't just move straight up. So what is it that we see that might be on the horizon that could affect things? Well, she starts talking about the Fed, different areas of price and support and resistance. And she basically said, I expect it's going to move up, but it's not going to last. How'd she do? All right. So this is where she said that. It moved up and it hit the major areas of support and resistance that we see in the market. It first moved up, as she said, and then it followed through on the downside, following the longer-term pattern that she was calling out. This is the sort of stuff that you get from our team when you're a part of the AMP program. All right, so huge moves down could be setting up for a relief rally. October 12th, this guy, Ben Russell, wrote this alert. Here's the deal. Stubbornly persistent inflation means the Fed's going to be forced to raise rates higher than what the market wants. The market doesn't go straight down. It doesn't go straight up. So getting a relief rally, but understanding that we're probably not going down, not done going down, is really what we're looking at. And David, we're sharing the statistics kind of like what you did. Look, keep in mind the data we're sharing, bear markets coupled with the recession last historically 14 months and declined 37%. Are we there yet, David?
Not yet.
Okay. So we probably have even more room to go down. Let's talk about last year. David, here's what this S&P 500 did for 2022, down 19%. That's substantial.
Yeah.
So look at
20% of your neighbor's money is how we like to say it. If you guys are in AMP, then your neighbor lost 20%.
And look at the tech stocks, NASDAQ, down 32%.
Wow, that's really big.
This was a tough market. It looks easy looking back, but this was a tough market for the average investor. So how did we do, Pastor? Let's start publishing some results. We have different categorizations of risk inside of our AMP portfolios. For 2022, our most aggressive portfolio, we lost 1.74%. Compare that to the market. Our growth portfolio, almost flat, down just 0.5%. Again, compare it to the market. Our balanced portfolio, which we've actually got a lot of gold and silver, right? We're very conservative in that sort of it was up 0.13%. And our ultra portfolio, where we do some trading, in the ultra portfolio where it does trading, we're down 0.3. So these are statistics straight from the Interactive Brokers website, where what we do is we go in and we track the performance for that category, and that is net of fees.
What we're hoping is going in, now that we see or have a pretty good grasp of this bearish market, we might be able to, I mean, if you look on more of a fiscal year than a calendar year, throughout this entire bear, I think we're going to come out ahead. I don't think it'll be a negative.
Okay, so we just talked about the real published results of what our program did for this last year, where we can actually say this is what we did. This isn't theoretical. This isn't some exercise. This is published, capable results of actual portfolio management. And Pastor, the reason why I want to call that out is because this slide is something that you created. And I think that this is the real power here, because we talk about generational wealth a lot at TRADEway. So what would happen if, our friends didn't have to go through these 28% drops like what we just went through, right?
Right, exactly. Man, you start, let's say you could be in cash for most of these corrections. And every year except the first year of a new bull, all the other years, even in a bull, 4 times a year, there's a major correction on average. And if you just stay in all those all the way down, that's a lot of time you've lost. Even if it comes back up, you may not lose the money, but you lose the time, which is the same thing, really. But imagine if you multiply that mistake by 3 generations. But if you turn around and put it in the positive, where you go to cash at the top of that thing, let it go down, and then try to get back in the market at the cheaper prices when it starts moving back up, and you multiply that positive for 3 generations, what would that look like?
Wow. Okay. So hold up a second. I think you just said, don't think about just yourself. Think about your family and think about 90 years. And what would it mean for you and your family to avoid these 28-ish% over your 3 generations? And what could that have looked like for your family and your long-term generational wealth? You're on mute again, sir. I'm sorry, you're on mute, David.
You get out to the 3rd generation, you're starting over because you have no money left. So every generation, every 2nd or 3rd, they just have to start over. And it's a cruel, hard world out there. The Bible says we're supposed to lay aside for our children and our grandchildren for that reason. And you can't do it if you're multiplying these kinds of errors. So on the other hand, if you multiply being able to add some oomph to your return by getting out at the right time and then buying back in when the market's lower, and you do that 4 times a year, that adds a lot of clout to the ability to create wealth over generations. And that's the potential we want to give you guys.
That's amazing. And well, we want to talk about long-term investing. I think 90 years is pretty long-term, right? But it's not just about us. Okay. So probability math, trading skills, market tone, knowledge, all of these things come together, right? So when we're looking at this, how different might your portfolio look with this approach? Well, I want to be upfront. We cannot tell the future. We can't. But all we can do is we can look at probability math, and as traders begin to make decisions about how to be defensive when the markets tell us that it's probably a good idea to be defensive, because we want to try to avoid these huge downtrends. And Pastor, you said it best. We avoid the huge downtrend so that when the next bull hits, we got more of our capital ready to go. And I'll never forget my first day at Step One. It was with you, by the way. You said the most money to be made is when?
The first year of the next new bull.
Okay, so we've talked about how long it takes to recover from these crashes. How different might your portfolio look if you were defensive through the bears and you were able to have more of your money ready to go for those huge increases that we know come after these bear markets? Wow.
Yeah. Ben, we're looking at some pretty small negative numbers, but we're not done with this bear. I think by the time we're done with it, we will make that back and we will have lost zero money during the bear, and we get to start the next new bull with all the money. That's going to be exciting. That's our goal, right?
You got it. So, Pastor, here's the first opportunity, right? We've talked about some pretty nasty headlines that we've seen. And most of the time, and Jenny, if you could please launch poll number 1 for me. This is the opportunity for you and those that are out there. If you would like for us to be able to have some information to help you out, this is your first question. Have you ever asked your investment advisor to go to cash? You do know it's your money. Most of the time, the answer, Pastor, as we ask this question, most of the time people are like, I didn't even know I could go to cash.
That's true.
Right? And what do we mean by going to cash? Well, for example, within our system at Interactive Brokers, that's the technology that we leverage, you can actually sell your position and have it in what's known as a money market or a near cash instrument, and they pay you this thing called interest. Did you know that within most programs, there is something near cash that you could go to with a financial advisor? Now, that's different than if you're in a 401k. Most 401ks do not have a near cash instrument. But did you know you could ask your financial advisor to take you to cash? Have you ever asked them? That's the question. Take a look at that, Pastor. We actually have a lot of people that didn't even know that they could that they could ask their advisors to go to cash.
Yeah.
Wow. Okay, well, thank you for your input today. I will tell you that as a result of this poll, almost half the audience didn't even know that they could go to cash. About 10% said that they argued and they made them do it anyway. That's the TRADEway people there. And about 12, their advisors did it without argumentation. Okay, now this bottom one, Pastor, is what hurts my heart. Take a look at that last answer. Not applicable. I do not have an advisor. Part of why you created Amped is because you wanted to be able to make it to where people like what we're talking to right now on this webinar have access to people to help them with their long-term funds. It's not easy to find a financial advisor willing to work with clients that don't have lots and lots and lots of zeros behind their name. That's not your heart about Amped, is it?
No.
So part of why you're here today is we want to give you the opportunity. If you want to work with a financial advisor, we'd love to tell you more and to be able to help you to see if this is a good program for you and your family. Okay. Let's get going on the next step here, Pastor, because we're running a little short on time because we both like to talk. So
that's true.
Amped stands for, again, Assisted Managed Portfolios by TRADEway. It's backed by the authority of Scripture. And what I want to do is just call out some of the things that God gave to you as a way in which you built this program. We're going to go look at the Bible. We're going to get those economic principles straight from Scripture. And we're not the first to do this. David, you're not the first to do this, right? We look at all these Ivy League colleges that have now completely forgotten where they came from, and they all started as preacher schools, and they use the Bible as their textbook. Okay, so it was really good then, and it really led to a lot of prosperity. Maybe we should go back to some old methods. All right, so here's one. Here's Ecclesiastes. Ecclesiastes. Now, Pastor, we leverage this. This is a huge part of the AMP program. It talks about casting your bread upon the waters. It's give a portion to 7, give a portion to 8. Well, that sounds like diversification to me. And guess what? It certainly is. Oh, so diversification from Scripture. Solomon, writing Ecclesiastes, had a little bit of wisdom to share with us.
Yes, he did.
Okay. Now, what about diversification? Well, he that observes the wind, risk. He that observes the wind shall not sow. Meaning that if you're always afraid, if you're always finding an excuse not to, and you just put your money in the mattress, it doesn't grow, right? So you got to take a risk to be able to have a potential return, straight from Scripture. Now, this last one, take a look at this. For thou knowest not whether this shall prosper or that's going to prosper or whether they're going to both be good alike. Let's unravel that. Well, we don't know the future. All right, so we do diversification across different sectors of the economy. Why? Because we're not God, and we don't know what he's going to do. So the program you built, Pastor, we divide into 8 categories. We divide into 16 subdivisions, come straight from Scripture. That's how we build our AMP portfolios. The portfolios that you saw, how they performed through 2022, all of these things come straight from Scripture. Correlates to things that we know today. All right, let's talk a little bit more about logistics. Because one of the questions that I helped answer for a client here recently, why don't more people do this? I gave you a little bit of a clue. It's not easy. If you don't have the right technology, getting in and out of the market, being able to do diversified portfolios, buying and selling, it's not easy. So, Pastor, you worked with Interactive Brokers, our brokerage partner, for how long did it take for you to be able to help build this program with them?
It took 2 years before we even started, just to get the software working and doing what we wanted it to do for AMP. And then a better question is how much have you had to work since then, to do the new things we want to do? And what about like going into inverse positions? What's that like for you guys?
Well, it's actually not as easy as it used to be. Starting about 3 years ago, the regulatory agencies actually made it hard for people like you and me to leverage those inverse positions. They changed the name of it. It's now called a CLP, a complex leveraged position. And we help you as a team to be able to make it to where your account has the capability of being able to get into those positions as long as you meet the required minimums. And it takes us a lot of work to be able to make sure that functions. And every once in a while, so you'll see Jenny Taylor in the background, we're getting people into the positions. They're like, why did it fail on this account? And something changed, and we have to go back in and give you those permissions again. They don't want you trading these. What does that tell you? The game's rigged.
Yeah.
So use our technology, use our opportunities here. Interactive Brokers is a great partner for us because of what they do. They give you a great portal so you can see all of your progress. They tell you when we take action. And there's one more thing, Pastor. When you told me about this, I went, oh boy. Remember when we said about going to cash? Remember when I said about paying interest rates? Well, how much is Interactive Brokers paying you? Well, whatever the Fed rate is, which do we still expect Fed rates to go up?
Yes.
Okay. Here's their formula. For everything that you've got deposited above $10,000, they will pay you whatever the Fed is paying minus 0.5%. That's currently 3.83% per year. Have you looked at your savings account?
That's just when you're in cash.
Okay, so being in cash means that you can still have the opportunity at Interactive Brokers of taking advantage of their very aggressive money market rates. That's a pretty powerful enablement to our program. So some people are like, well, Ben, if you're in cash, you're not making money. I'm like, but I'm not losing money and I'm still making some on Interactive Brokers. Huge part of our program. All right, so what do you get when you join AMP? Well, you get alerts from us telling us what we think, great support from our team, the opportunity to be engaged with a great brokerage partner like Interactive Brokers, and you have the potential, leveraging those CLP positions, those complex leverage inverse positions, we can make money on the way up and on the way down is our potential opportunity. And most of your financial advisors only understand a bull market environment. All right, how else do you benefit? Well, David and the biblical philosophy underscores everything we do. And we're going to avoid being in the market all the way to the bottom. It makes no sense to us as traders. We want to help you with diversification, and we want to help you to take advantage of your short-term trading skills. So what does that look like? Well, we call the program AIM, A-I-M, which stands for Advanced Investment Management. And this is the program where we do it all for you. All right, we click the buttons, we do the work, we give you an opportunity to be able to bring your money into the Interactive Brokers program, and we do all the work for you. Let me tell you a little bit more about that. All right, so AIM is over here. We have startup fees associated with it because we got a team of people helping you to do it. It takes a decent amount of work to get your account started, get your money moved over, get you invested in the market. There's some startup fees for that. Pretty nominal. And then you're going to pay us an annual percentage to help you to manage your funds. Okay, what is that worth to you and your family long term? Well, TRADEway is going to make some money. And as you make money, our goal is to try to help preserve and protect your assets and grow them as it makes sense with the market. Now, there's some of you out there like, can I do it myself? You're the DIY type person. You're the individual that goes to YouTube and finds the how do I fix my toilet, right? You want to do this yourself? Guess what? We've got that opportunity as well. You can do the pro program, the Amped Pro, where we teach you how to do what we do. We give you our technology. We give you the training and we help you to set up your accounts. And then we alert you when we're making a change and we recommend you make a change. And then you go do it on your portfolio yourself. So which one makes more sense for you? Hey, Jenny, this is often a question I'll ask you. You and I, we talk to an awful lot of our clients out there. Which program do people choose most when you're talking with them?
Well, in about the year and a half, year and a half, year and 3/4, I've had everybody sign up for AIM except for one person.
Okay. So, now why?
That means since we launched AIM, the reason is in all reality, you have to be able to be available to get on your computer to press the buttons to get into the market any day the market is open. 365 days. Well, that's not how many days it's open, but literally every day, because at any point we could be like, okay, well, we're going to do this. And it for sure doesn't work for doctors or surgeons or dentists. But when you come to think about it, it's not even all that great for pretty much anybody else, because you just have to be prepared always. You have to be on standby always.
Well, and I'll echo that. I have found that most of the people I talk with are like, I don't even want the stress of it, Ben. I would really prefer you and your team to make those difficult decisions. And yeah. It just comes down to what is it that you like. We have some people that want to do it yourself. Right. We've got that opportunity. We've got people that want us to do it all for them. We have that opportunity. All right. So as we start to close here, Pastor, we do have a couple of other questions that people had. What do you suggest, David, that we do for 2023?
Well, I think, Ben, that, with regard to the long-term money, long-term investment money, we're going to watch for these opportunities to get into some inverse plays. We're not going to have hardly any times when we're buying stocks or buying ETFs for up moves. We're mostly going to be watching for the market to pull back up to a key moving average, bounce down, and then look at some potential inverse plays. And I think for your short-term money, guys, you need to make sure you get out there to learn the skill sets of step 1 and step 2, because step 2 will teach you how to buy puts. And puts have the potential of making money when the market's going down or when that stock that you're in goes down. And those are the skills you need to get right now, but also just the general skills of trading, because when that next new bull starts, you'll turn that around, you'll buy call options when it's going up, right? But for the next few months of this bear, we're going to be looking at cash positions. And then when the market pulls back up, hits a key moving average and bounces down off that, headed back down, we'll be looking at inverse positions for your long-term money. And you guys can be looking at puts for some of your shorter term trades. And I think it'll be great. I think, I don't think you should be buying the dips like the news is telling you to do.
Yep.
That's nonsense. Don't buy up moves when they dip thinking, oh, now it's cheap, let's get in. You don't do that in a bear market crash. Be watching for it to pull back up like they think it is. And then when it bounces down, look at puts, something that'll make money on the way down. Just keep in mind, it's going to take quite a while of them raising the interest rates to kill the money supply to get that inflation rate all the way from 7 to 2. And this is going to take a good amount of time, I think, to do that. So we're going to be looking at these down plays.
Okay, so amped. We have this philosophy of not fighting the Fed, right? That's that buy the dip mentality, by the way, that you just mentioned. That's what people used on the way up. What about on the way down?
Well, same thing. That's why when you read the news and it says, oh boy, you need to buy the dips. See, that's fighting the Fed. And we don't want you to do that. We don't want you to see your little favorite stock and maybe it's rolling and it starts to move up and you get all excited. You want to buy that stock or buy call options. You don't want to do that when the overall market is trending down. You're going against the rules of having 3 legs on the trading table. You're kind of going against the news and the market tone component. You want all 3 to say go. Well, the only time they're all 3 going to say go right now is on a down play, like inverse ETFs or puts. I think that's my opinion. And so that's kind of what we'd rather see you do than try to fight the Fed, because right now the Fed is in a position of trying to kill the stock market. They won't say it that way. They're trying to kill your job so that you get laid off. They won't say it that way. But listen, that's going to create some major problems in our economy. And so thank God that he put puts on the shelf for us. And inverse positions, our neighbor is going to lose maybe up to half his money, and you may gain money over this. If all you did was still have your money when it's over and you go into that next new bull market, it's going to be fantastic.
Interesting stuff. Well, Pastor David, thank you for those answers, sir. I can tell you, I echo that. I genuinely believe that we have more pain coming because the Fed is not done. And to me, this is the litmus that we will be watching primarily. The Fed policy that affects monetary and the money supply that you've described, to me, that is going to be some of the key factors that we're going to be watching for to figure out when's it time to get bullish again.
Absolutely.
All right. So what is the opportunity for you, my friend? You've listened to us, Pastor David, giving us his wisdom, the systems that we've been able to build at TRADEway to be able to help you to be biblically sound, safer, and click button simple with your long-term funds. If you want help with that, that's why we're here. And all you got to do is, if you can launch poll number 2 there for me, Jenny. Friends, if you want to meet with me, Jenny, David Verbugen, one of our other investment advisors, we want to help answer your questions. Again, this is not a sales call. This is let's talk about your financial situation. Let's talk about, do you have an IRA? By the way, if you have an IRA, we can help you with that. We can help you to transfer that IRA, and then we can help to manage the money. You have a 401k. Often 401ks can be rolled over into an IRA, and then we can help you with it. All you'd have to do is find out from your employer, how much can I roll over? And if you can roll money out, well, we can help you. We do Roth IRAs. We've helped people with savings account. Oh, I love this one, Pastor. This was awesome. Take a look. Listen to this. Recent client. You know, Ben, we saw this decline in the housing market coming. We sold our very expensive home in a very expensive zip code, and we moved to a cheaper place, and we're renting a house. And we have our money sitting in a savings account with no interest bearing on it. What can I do, Ben? I'm like, bring it over to Interactive Brokers, right? Let us help you with it. We can help you manage a portion of the money, and you can keep the rest of it just in a savings account that's making 3.83% right now. They loved it, right? So we can help you with things just like that. But here's the problem. Your situation is different than everybody else's situation. And unless you talk with one of us, we can't help you. You want to help? You want our help? Just click on the button. Let us know what you're thinking about bringing into the program, and we can be prepared to have that conversation about what are your fees and what is it going to cost if you decide to move forward with us. Now, how does that work from there? Well, when you click on the button, guess what? You're telling me that you want one of us to talk with you. you're going to get an email from one of us, probably, if not today, by Monday, with an invite that says, let's schedule your personal call. You click on the invite. You find a time on my calendar or Jenny's calendar that works for you, and then we have your personal call, and we figure out if this is a good fit for you. That's how this works. Okay, well, I think we're at pretty much the end of our webinar. Jenny, Pastor David, were there any questions, Jenny or Cassandra, were there any questions that came up that we need to cover?
Yeah, I was just, we got a couple of people asking, is there a minimum investment required?
That's actually a great question. We would recommend that for the AIM program, where we have the complete diversification across all sectors of the economy, we would recommend a $25,000 minimum. If you don't have $25,000, there are some programs that we offer that can have as little as $8,000 invested.
Okay. And then another one that is just really helpful is to answer, like, where, where are the different, what type of different accounts can we help them with? Can we help with, retirement accounts or 401ks or
Absolutely.
Trusts? So why don't you hit on that just a little bit as well?
I think I did just cover that one, but let me repeat. So if a 401k, for example, if you can roll it over and you call your company and ask, we can help with that. If you have an old IRA or an old 401k from a previous employer, we can help you roll that over into Interactive Brokers. Absolutely, we can help with that. And then even those savings accounts that I offered, right? So sometimes I talk with people like, I've got a couple $100,000 sitting in a savings account doing nothing. I'm like, let's talk, because I think you need to. Okay. Great stuff there, Jenny. And I've been kind of watching the questions too. I think that those were the main ones. What about a business account? Actually, David, that's a great question. We help a lot of individuals with their business accounts because then they don't have to pay all the professional trading fees. Guess who pays the professional trading fees?
Absolutely. That was difficult to do with Pro, but it works now with AIM.
So I think this has been a pretty amazing webinar, Pastor. Thank you for sharing your knowledge, the history that you have through these previous bear markets, giving us a glimpse as to what is a potential game plan for 2023. It's been a fun webinar, my friend.
Absolutely. It's always fun to do one with you, Ben. We're right in tune with each other. So it's been great. I enjoyed it. Great to have all you guys with us too. We really appreciate you spending your personal time with us on a Saturday. That's fantastic.
Well, so as we close out, I think that the final thing to do is to say what's on the screen. Thank you. Sincerely, thank you for spending your time. We believe in our mission strongly. We do what we do because we want to help people. If you're looking for somebody who wants to help you, give you a different perspective, help you to get access to technology that just not everybody gets, try us out. Ask some questions. It doesn't cost you anything to ask the question. You don't know what you don't know. Let us help you. And if that sounds good to you, if you click the button, be looking for that email from me, Jenny, David. If you're watching this as a replay, and I know that there's several of you that are watching this as a replay, all you got to do is go out to tradeway.com/amped, AMPT. You can sign up for a consult there, or you can email our division, amped@tradeway.com. All right. So as we close out, I just want to caution you. I don't think we're done going down in 2023. I would absolutely ask and please pray about your investment decisions, because I think that we have some serious economic conditions where some of those numbers that you've seen in our webinar could become the reality, because we have yet to see the major selling that typically comes at the bottom of a bear market. I do not think we're done. So let us help you protect it. Okay, Pastor, any final words?
No, I just want to thank you guys for being here again. And thank you and Jenny for being here and helping today. It went great. And guys, just pray about it. And this whole thing is built around wisdom that comes from the Bible. And that's why it works. And we can be a help to you. Just give us a call. Let us talk to you about what your needs are. And we'll try to meet those needs. Thank you so much.
Okay. Goodbye, everyone. And thanks again for being here.
Goodbye.